Good morning, Randall. Thank you very much for doing this.
Yes, good morning, everybody.
So, as we normally do here, I'm going to hand over to you just to tell us all about the fund.
Mhm.
There are some disclaimer slides here that we're not going to spend enough time to read, so I think you're going to have to pause the recording and make sure you read them properly. But I'm going to hand over to you and let you tell us all about Sequoia Economic Infrastructure Income, please.
Great. Well, thank you very much, James, for the opportunity to present on the show. And I want to thank you and the entire team at QuotedData for inviting us on. So what I'd like to talk about, I'm Randall Sandstrom, as James said, I'm the chief executive of Sequoia Investment Management Company, which you can see the logo behind me, Simco. That's what we refer to Sequoia, the IA, as. And we are the investment advisor, as James said, on the Sequoia Economic Infrastructure Income Fund, where the ticker symbol is SEQI. And maybe before we get into page 4, just to talk a little bit about what is SEQI. SEQI, it's a listed fund. It's on the London Stock Exchange. It's a little bit different than other infrastructure listed funds in the sense that it's a debt fund. So what we do is we make loans, high yielding loans on infrastructure projects globally. And these are done in jurisdictions that are developed markets. We don't take any emerging markets risk. So this is as opposed to an equity fund where the manager will invest in the equity of a project, which represents ownership in the project. We're a little bit more like a bank in the sense that we will make loans to infrastructure projects. We feel that that's a really strong place to be, that high up in the capital structure up here, in the sense that equity can be a great investment. It can be a good place to be. It does tend to be more volatile. The returns are typically a little bit higher than debt, but you are first in line to equity is to lose money if there's underperformance or possibly a default on the asset side. So we feel a little bit better about being higher up in the capital structure. If we just look at page 4 here, you can see that SEQI offers a diversified portfolio, and we're going to talk a lot about that, of what we call private loans. So as opposed to what some people call a public bond, for example, or an actively traded bond or note, we make private loans. So these are loans oftentimes that SEQI, the fund that we advise, will make to a project and be the only lender. We call that a bilateral loan. That represents a large portion of the loans that we make. Sometimes we'll team up with other lenders and do what we call a club deal. And there you might have 2 or 3 lenders to a project. In both of those cases, bilaterals and club deals, you tend to have a lot of say about pricing and setting the terms of the loans to benefit investors in the fund. So if we just go through slide 4 here, this is an executive summary. You can see that SEQI's, it's got a long track record. It's a mature fund. It's been running now for about 9.5 years. It's large. It's the largest debt fund on the LSE. The NAV is just about 1.3 billion pounds in size. We run a diversified portfolio. As I mentioned, we'll talk more about this later, but we currently have 56 different investments or different loans across 30 different subsectors and across 10 different investment grade jurisdictions. And by investment grade, we're talking about higher quality jurisdictions as opposed to emerging markets type of risk, which we don't take. Third bullet point down is the fund is currency hedged. Our current hedge ratio is 100%. So we hedge away all of the FX risk. And we're going to talk more about that and other risks that we're exposed to later on in the presentation. But the point there is that what we want to do is to either eliminate, mitigate, or manage various risks that we're exposed to, what we call exogenous risk, interest rate risk, FX risk, business cycle risk, so that the main risk that we're left with is what we call credit risk, and that's the risk of lending. And we want the return to our shareholders to be a function of that risk as opposed to these other risks such as FX risk. Our dividend has been growing over the years. We started back at the IPO in 2015 at 5p per share. And you can see that the dividend currently is 6 7/8p per share. and that was raised just in the beginning of 2023. Sequoia investment management companies, obviously the investment advisor, I've already mentioned that. So what is it, the bottom set of bullet points there, what is it that's neat about infrastructure debt? Why do infrastructure debt? And there are a couple of things to talk about. One of them is that infrastructure projects are generally quite resilient. And what we mean by that is that infrastructure tends to perform well during periods of economic contraction or economic softness. We saw that during COVID. And the reason for that is that people, users of infrastructure, people and businesses, tend to use infrastructure even during times of economic contraction. You know, one needs to pay their lighting bill, their phone bill. If they want to drive on a toll road, they need to pay that. These sorts of charges for infrastructure pretty much are resilient to economic softness, and they need to be paid for even in times of weakness. The other point that makes infrastructure resilient is that expenditure for infrastructure tends to be a relatively small portion of one's disposable income, be it a mobile phone bill or a toll. And so that makes it less sensitive. It's not like a big ticket item that a consumer durables company might sell, like a car, which is really much more discretionary. People can put that sort of expenditure off. That's not the case with infrastructure. Also, infrastructure, we're going to talk about this next point more as well, tends to have lower default rates and lower loss rates, which is really good, relative to similarly rated corporate bonds and other types of general credit. And then lastly, on page 4, this is really important, infrastructure debt tends not to be too crowded. You know, if you look at the corporate loan or the corporate bond sector, there are hundreds and probably thousands of investment managers like us around the world investing in corporate loans and corporate bonds and trying to figure out where the alpha is and where the cheap cash flows are, so much to the extent that a lot of that alpha is wrung out of the return, whereas infrastructure debt is much less crowded. So you can tend to get better returns per unit of risk and what's called more alpha, which is more return than you should get given a particular level of risk in infrastructure debt than you can in other credit sectors. If we go on, James, to page 5. Now here, what I wanted to do was just to demonstrate through these two pictures the size of the opportunity. So what we've got is on the left-hand side, a graph of the growth in infrastructure equity. And then on the right, we've got the growth in infrastructure debt. So just looking at the growth is important. And the reason that we're seeing so much growth is really just a function of the amount of infrastructure that's needed around the world. This is particularly the case in the US, but it's really more of a global phenomena. In the US is where we have our largest exposure, and we'll talk more about that later. But just to put some numbers, you can see that on the left-hand side, the total equity capital that's been raised is 1.2 trillion. Now that's the amount that's been raised and put to work, but also raised and not put to work yet. And really the story here is that infrastructure equity is going to need to be financed. If a sponsor, which is the name in infrastructure for an equity investor, if they go out and buy an infrastructure project, they will almost always, not always, but almost always borrow money to help finance that purchase. Same principle as when someone buys a house. They might put up a 10 or 20% deposit and they're going to get a mortgage for the rest. So it's the same principle when a sponsor buys an infrastructure project. They're going to look for funding. Typically, that debt is about 2 to 3 times the size of the equity check. So that means that with that 1.2 trillion of equity that's been raised, you're talking about 2 to 3 trillion of infrastructure debt that's going to be raised, that's going to need to be raised to finance that. So it's quite an opportunity. And there's a lot of demand for infrastructure capital, much more so than the amount of supply of infrastructure capital. That's particularly the case in the US. And what that means is that spreads need to increase. They need to go up in order to attract that additional capital. If we go on to the next page, please, James, we can look at page 6. This is just a little snapshot of SIMCO. Again, we're the IA. You can see that we've got 20 full-time employees. These folks work on infrastructure. We've got a breakdown of the team coming after page 6 here. But we are a 20-person shop. We're devoted to infrastructure debt. And that's quite large. There might be larger managers in infrastructure that could be attached to an insurance company, for example. These are other managers in our space. But typically, not always, but typically the groups within that insurance company are smaller than 20 people. If you look in the middle column there, value add, we've got a little bit of jargon, which I'll explain later, but one of the measures that investors use for folks like us is what's the loss rate? How much money have you lost by making an investment? And we've lost on average about 58 basis points per year. Now that's in the IRR, which I'll talk about later, but that's about 0.6%, which is included in the circa 7% IRR on NAV that we've made for our investors. We've got a little comp there. The average for equivalently rated or similarly rated corporate debt is about 165 basis points a year. So we've significantly outperformed. In terms of origination, we've made over 240 loans over the last nearly 10 years. So we've been pretty busy, and about 100 of those have been in the US. You can see down at the bottom in the middle there, ESG leadership. I've got a slide on that coming up. We've really been a leader in that area, and that leadership was recognized by us winning the 2022 award for Best Infrastructure Strategy. That was by the folks at CFI, and that's an investor-led award. And then down at the bottom there in the middle, the AIC, the folks there awarded us the Best Investor Fact Sheet for 2023. So we're really, really happy to be getting that sort of coverage. We go over to the next slide. James, you can see here, it's just a little snapshot of the team. These are the 20 different individuals that we have. You can see over on the sort of just to the right of the middle, the gray boxes, those folks represent what we call the credit transactions team. So that is the team that goes out and originates our loans and then executes the loans and then monitors them going forward. Just to the left of that, the light blue boxes, we've got 6 individuals in portfolio management. So that's the team that manages the investment portfolio. Over on the far left in the blue, we've got 3 individuals with 1 senior analyst just getting ready to join us doing investor relations work. We've also got a chief risk officer as well. You look at the next page, page 8, this talks all about ESG, and this is a really complicated area to the extent that we've gone out recently and hired a sustainability manager. Her name is Leah Dean, and this is something that, you know, ESG and sustainability wasn't really a concept when we did SEQI back in 2015, but it certainly has become one. It's become very important. So we've got some highlights here on ESG for those investors out there that this is important to. So top left, SFDR. This is the Sustainable Finance Disclosure Regulation, and we're what's called an Article 8 fund. And what does that mean? Well, it means that we need to pay attention to ESG considerations when we make a loan. And within SFDR, there are basically 3 types of funds. There's what's called an Article 6 fund, which by and large doesn't pay attention to ESG. There's an Article 8 fund like we are, which does need to take ESG considerations into account when making an investment or making a loan. And then there's what's called an Article 9 fund, which is the highest level. That would be typically like a renewables type fund. Down from that, you can see that SIMCO is a member of the UN PRI. This is the United Nations Principles for Responsible Investment, and the various factors that the PRI code talks about are over on the far right-hand side of page 8. As I mentioned on the left, you can see the CFI award that we got. Now, one of the main reasons that we got that award, it's not just everything on this page, but one of the big things that we did, and we were one of the first listed infrastructure funds to do this, not the first, but one of the first, is that we bring in an auditor, it's KPMG in our case, we've done this for a few years now, to do what's called a limited assurance. And really what that is it's similar to an audit, but it's an assurance of a baseline level of work that we do from that we get from KPMG, and they come in and they look at everything that we do on ESG, and they make sure that we're doing on ESG what we say that we're doing. So we've actually had that assurance level baseline work done from KPMG for a few years, and I think that had something to do with the CFI award that we got. What do we do on ESG? Well, it's really, there's a lot, but it's really summarized right in the middle there. Negative screening. So this is where we take out things that we know won't pass ESG. A perfect example there would be oil and gas upstream. That's something that we just don't really do. And then also coal-fired power generation. That's something that we're not too excited about either. And then we get into thematic investing and positive screening. And this is where we look for things that we like and we feel that will do well on our ESG scoring. So a perfect example there would be wind and solar and energy transition in general, and particularly some parts of energy transition, such as wind and solar, as well as digitalization, which is our largest sector, which we'll come on to. If we go to the next page, page 10, we'll start to talk about the portfolio. And there's a lot of information here, so I'll boil it right down. What this page is really about is risk management. And what I mean by that is, as I said in the intro, we want the return to investors, which we're going to come on to be a function largely of credit risk. That's the thing that the folks at Sequoia are experts in. So we want to therefore get rid of other types of risk. So the first type of risk would be portfolio risk. And what I mean by that is variability in the income to the portfolio. The best way to decrease that variability and decrease the portfolio risk is good old-fashioned diversification. You can see on the top left there, we've got 56 different investments across many different subsectors and jurisdictions as well. So that brings that portfolio risk down. The second risk we want to minimize would be interest rate risk. So if we, again, stick to the left-hand top gray box and you go down to the third row, you can see the average life of our investments is 3.7 years. So that's pretty short relative to other types of debt portfolios, which can be, 10 years, for example. So that tends to bring down the volatility of marks due to changes in rates because shorter term loans are just less volatile. And the other reason that our interest rate risk is pretty low is over on the right-hand side. If you look at the blue bar, third one down, interest type, you can see we've got a fairly big chunk of the portfolio in floating rate, 42%, and the rest in fixed rate. And by floating rate, what we mean is that the coupon, or what's called the margin on a loan, is reset as the risk-free rate, be it SONIA in the UK or the measure in the US or Euro LIBOR on the continent. When those base rates change, the margin is reset, so it floats with. So that tends to bring down interest rate risk a lot. Now the measure of our interest rate risk is a modified duration. Again, over on the left, fourth line down, 2. So that's portfolio modified duration. And I don't want to get too technical, but that's just a measure of how much risk on the interest rate side that we're taking. What that 2 number means is that if interest rates were to change by 1%, you would expect the NAV value, the NAV, to change by 2%. So that's relatively low versus other types of portfolios. If we go down to the bottom of that gray box on the left, you can see defensive sectors. So this is how we manage business cycle risk. And it's important to say that infrastructure is already not as cyclical as some other markets for the reasons that I said in the very beginning, that people need to use infrastructure even during an economic contraction. And the price that people have to pay to use infrastructure is a small part of one's income typically. Nonetheless, we want to take that a step further and put a large portion of our portfolio in the defensive sectors within what is already a pretty defensive market. So you can see we've got 52%, and down in footnote 2, in sectors such as digitalization, accommodation, utilities, and renewables. And then the fourth risk that we want to manage very carefully is currency risk. That's FX risk. And you can see down on the right-hand side at the bottom, the green bar, as I mentioned earlier, that hedge ratio right now is 100%. If we go to the next page, page 11, just a little bit more information here on the portfolio. And these are all the subsectors and sectors that we're invested into. You can see that we have 8 different sectors divided by the thin gray lines, and then we have 30 different subsectors. So diversity is very strong in the SEQI fund. That really helps to reduce portfolio risk. And we've always run a well-diversified portfolio. You can see that our largest exposure is digitalization, which is one of the major themes in the market right now, particularly for infrastructure, along with energy transition as well. And under digitalization, if you can read that, I know it's slightly small print. I apologize for that. The types of subsectors that we go into: data centers, telecom infrastructure services, as well as in the past, we've done an undersea data cable, and then we've also done mobile phone cell towers as well. If we go on to page 12, we can just take a look at a few examples of deals that we've done. And given the time constraint, I'll just cover maybe 2 of these on the two, one in the middle and the one on the right-hand side. So in the middle, what we have there is a power generation plant. So we call this Generation Bridge. It's a deal that we did in the US. And so this plant, like all power generation plants, they make electricity and then they sell it. And there are some themes that we want to look for. This is a really big sector in the US, so there are lots of opportunities for investment. And the sort of normal themes that we look for would be, we like contracted cash flows. Some power generation plants sell power once it's produced into the open market, what's called the merchant market. And that can be relatively risky. It can be profitable, but it can be quite volatile. And that's more of an equity theme. That's not really as much of a debt theme. What we would prefer is that the power is sold on a contracted basis, and that's done through what's called a purchase power agreement. And that could be with a corporate, for example, or corporates where the power plant is under contract, so they have visibility about their revenues. Something else that we look for is a good sponsor. That's the equity investor, the owner of the plant. And we would prefer them to have, lots of experience and deep pockets as well. If, for example, it's being constructed and there are cost overruns or construction delays. Something else that we look for would be a portfolio of turbines. It is possible to do deals where you finance one turbine, but everything else being equal, we would prefer, such as this one, a portfolio of turbines to finance. And then lastly, in the US, for example, there are several different power markets, and we have a preference for a power plant that has exposure to different markets for diversity. So on this one here, you can see right up at the top, 8 different generation facilities. Those are the actual turbines, and it's spread across 3 different markets. You can see there's some jargon in there, NYSO and J and NYSO. That's the New York City market, and then the New York State market. And then we also have exposure through that power generation facility to the New England power market as well. Over on the right-hand side, this is a really, really neat loan that we did to a floating liquefied natural gas vessel. This is one of the most efficient vessels in the world. What we did was we came in at a really late stage, and we helped finance just the end of the construction. So what we did, it was a big ticket. It was $130 million that was needed. So we put in 20 million from SEQI, and then we brought in a co-lender for the balance of 110 million. And this is a 3-year loan. And what's really neat about this is that this ship is under what's called a long-term tolling agreement with one of the major integrated oil companies in the world. So it's a good credit that tolling agreement is with, and that serves to really bring down the business risk to that project. I'm conscious of time, so let me just very briefly talk about page 13. This shows our performance again, a lot of information. I'll just drill it right down. The black line, well, in all cases, these graphs, these line graphs represent the cumulative total return since the IPO. So the black line is the cumulative total return on our NAV, so net asset value, and the red line represents the cumulative total return on a high yield bond index. The ticker symbol is in the footnote. That's been swapped to sterling, so we remove any currency effect. Couple observations. You can see that the SEQI's total return, the black line, is much less volatile than the red line. And if you go back to the big drop, that's COVID. We all remember March of 2020 when all markets took a hit. And you can see that red line, those leveraged loans or corporate loans, those dropped about 20 percentage points, just the mark on those loans during that month. Whereas if you look at the black line, it's kind of hard to see. It's over the blue line. But our marks dropped about 10 points. So, and if you look at that day or that month rather, and other periods as well, what's called the asset beta or the volatility of our marks versus, in this case, leverage loans are about half. So that's called the asset beta. So our asset beta is just about half of the market. The other important point on the right-hand side, if you look at our cumulative total return, which is 66% over the life of SEQI, versus that red index, that's 35%. You look at the difference, you divide it by 9.5, you're going to come out with about 3.7 percentage points of outperformance versus high yield bonds. Now that's total return. So that includes the income component of total return and the capital appreciation component. Most of our outperformance is the income component, but nonetheless, it is outperformance. And if you look at private infrastructure debt, it tends to yield more than liquid credit that's comparably rated in a normal market. And a large portion of that increase, of that marginal difference, is due to what's called an illiquidity premium. Now, we want an illiquidity premium because our investment strategy in SEQI is largely buy and hold. So if we can get an illiquidity premium for our loans, then that's worthwhile to take. Just moving on, page 15, and what I'll do is I'll skip 16 and finish on 17. We've got 5 minutes, I think. Okay, so what's this? This is a measure of performance. It's a little bit technical, but I'll try and just simplify it all, make it more understandable. So default and recovery rates, and also using that information, you can calculate what's called a loss rate. I mentioned this a little bit earlier. So we've got 3 different things. Over on the right-hand side, we've got SEQI. And the way to read this, the dark blue bar represents the average per annum default rate, and the light blue bar represents the average per annum loss rate. And then on top of that, you'll see a light blue triangle, or diamond rather, and that represents the rate of recovery. So that's how much money you get back if a loan does default. And the rate of recovery is read off the right-hand vertical axis, and then the default and the loss rates are read off the left-hand vertical axis. So if you look at SEQI and you focus just on the light blue bar, you can see that our loss rate, this is the amount of money that we have historically lost if there's a default, it's actually, the number is actually 58 basis points. So it's less than 0.6%. So on that previous graph, I showed that the IRR on our NAV has run at just about 7% per annum, and 6.95%. And that includes this loss rate of almost 0.6%. So this loss rate is not on top of that return. It's already in the IRR. Now, how does that compare versus other markets? Now, if you look at infrastructure in general, same type of infrastructure loans that we make in terms of its credit rating. So what's called double B and single B, and that's a reference to the credit rating by the rating agencies. Folks can look that up on the internet. But infrastructure in general has lost about 66 basis points a year. So we've been able to outperform that by quite a bit. And then if just to compare that versus something, if you look at what's called non-financial corporates, or basically industrial bonds, industrial corporate bonds, and all these numbers are from Moody's, you can see the loss rate there has run a lot higher. It's about 165 basis points per year. So we've had really good outperformance. I think we can skip page 16 and just finish on the last page if we could, James, and go right to page 17. So these are three factors we feel that SEQI offers, and we feel that we're really well positioned to take advantage of a market which we think could be close to turning. So SEQI has proven itself to be very agile, and part of that reason is just its infrastructure debt. It performs well during times of economic contraction. We've tried to take a very balanced approach to using our cash, particularly in the market that we've seen since interest rates and inflation went up. So what we've done is we've had really a market-leading share buyback program, which we instituted, the directors of the fund did back in summer of 2022. It's a very large buyback program. The last time we looked, the amount of shares bought back were more than all the listed infrastructure debt and equity funds that are doing buybacks combined. So it's been fairly large. We've been deleveraging, and we're fortunate in that our balance sheet is very strong. Our portfolio is very cash generative. So we were able to pay off the revolving credit facility just with cash. We didn't have to sell assets to do that. And then thirdly, we've been very selective about the reinvestments that we have been doing with that cash. Just to talk about the middle performance, strong cash flows, as I mentioned. It's naturally a very high cash generative portfolio because it's high yielding. The portfolio yield to maturity is about 10%, and our average life is fairly short at about 4 years. So we get about 25% of that portfolio back every year that we can reinvest. And also that keeps everything fresh. It keeps, the rate at which we lend fresh, and it keeps all the marks fresh. We do our marks once a month, and PricewaterhouseCoopers is our valuation agent on the loans. In terms of that second bullet point under performance, we've continued to outperform that high yield index, that high yield bond index that I talked about earlier. The listed fund market in the UK is trading at a discount to NAV. The range of discounts are about 10 to 40%. Historically, before that happens, SEQI traded up until circa 2021 at an average of an 8% premium. But, the entire market's been affected with the situation right now. And so, but we're at the tighter end of that range. That range, as I mentioned, 10 to 40%. There are some outliers that are larger in terms of the discount, but we're right now at about a 15% discount. So we've been able to keep that at the more narrow end. Low average life, as I mentioned, that keeps the portfolio fresh. And then portfolio loss rates, as I mentioned earlier, have been comfortably better than the market averages. And over on the right, we talk really about the opportunity. We feel that, with interest rates starting to go down by the central banks and expected to go down a lot more over the next couple of years, and with inflation clearly having peaked in Euroland, the UK, and in the US and in other markets around the world as well, we think that it's probably a good time to invest in SEQI. That's not investment advice, but it's my personal view that our shares don't represent the true net asset value of our fund, and I think it's probably a pretty good time to look at the shares. And down at the bottom, lastly, on page 17, strong pipeline. This is the investment pipeline that we maintain in order for the cash that we use that comes in to reinvest into new loans. So that's something that we maintain on an ongoing basis. We've got a nice pipeline right now, really pretty much across the markets that we lend to, and it really represents what the portfolio would look like. If we were to invest in the loans that are in our pipeline, it would not substantially change the risk return profile of the portfolio. James, that really finishes up the presentation.
Yeah, now we've got some questions, so I'm going to run over a bit while we'll try and tackle some of these. So let's we start. Let's think about this interest rate risk thing, because that's obviously your discount opened up when um, rates started to rise.
Yeah.
Is there any hope? Do you think any sort of rationale to saying, well, if rates start to fall now, that would naturally narrow it, or was the fact that it moved out in the first place just a bit strange?
Yeah, sure. Well, my own view, and I think this is shared by a lot of people in the market, is that as we see rates go down, and we got to distinguish between rates. There are short-term rates, like the rates that are more or less controlled by the central banks, and then there are what's called term rates, like a 5-year gilt rate or a 10-year U.S. Treasury rate. But as rates move down, we do feel that liquid credit will be less interesting to investors because those rates will go down. And folks will start to come back into more of the alternatives sector within the listed space in the UK listed fund market. And that would represent infrastructure, real estate, and private equity in general. So I think if you see that happen and you see more demand coming into the space, one would expect the discounts to NAV to narrow over time. Again, holding everything else equal. In terms of the first part of your question about the effect of rates, part of our portfolio is in the fixed part of the market. And there you would expect, if term rates come down, you would expect the prices on our fixed rate loans to go up. And that's really what the market refers to as pull to par. And what that means is that as those term rates went up, it's just a mathematical relationship. The price on our fixed rate loans went down. However, absent a credit event, you would expect those loans to mature at par. And again, the average life on our loans is relatively short, 4 years. So it won't take that long to get back to par. And that's called the pull to par effect. Now, that will happen even if interest rates don't move, the pull to par. But if they were to go down, then that pull to par effect would be a little bit more front loaded. So I do think if rates go down, it's going to have a positive effect on the market in general, particularly the fixed income market.
Great, thank you. Now, there's quite a few questions that are really all around how do you source your loans, and how do you choose how to structure them,
Yeah.
and how do you do that in competition with people like Ares and Apollo and Blackstone? Are they competing with you, or are you in a different kind of part of the market?
Well, there is competition, absolutely, and there's not loads of competition. As I adjusted just a little bit in the beginning, unlike corporate bonds or leveraged loans, where when a new issue comes out, if it's really interesting for investors, it's oftentimes what's called oversubscribed. And as an investment manager trying to get part of that leverage loan or corporate loan, you can be scaled back. Now, that's really not the case in infrastructure debt. It's just not as crowded of a market. But there are competitors, but we really haven't noticed it affecting our ability to source loans and to build our pipeline of investment. It has affected it to some extent, but not to a large extent. And the basic reason for that is if you go way back to 2008, as a result of that crisis of 08, 09, the banks obviously got into a lot of trouble back then. And what happened was there was a set of rules called Basel III, which effectively increased the amount of capital that banks have to set aside on loans that they made, particularly long-dated, illiquid type loans. And it went from sort of mid to high single digits to sort of 14, 15%. Not exactly that. It's rather complicated calculation. But the point is that it cost a lot more for banks to make these sorts of loans. So a lot of banks withdrew. A significant amount of capacity withdrew from the market. And then, so that was in Europe. And then in the US, I think it was 2016, November, the Fed introduced its own version of Basel III, again, making it very expensive for for banks to make these sorts of loans. So banks pulled out. But on top of the U.S. version of Basel III, something else kicked in, which is called Dodd-Frank. And that, again, is a set of regs born out of the 08-09 crisis. But in particular, it raised this capital requirement for what's called globally systemically important banks, GSIBs. And again, that's big US banks and big non-US banks operating in the US. So again, a lot of banks pulled out because of that. So we don't find that sort of competition from banks in the market the way that it used to be prior to the 08-09 crisis. In terms of the other part of that question was, how do we source loans? And really, this is a question of staying in touch with the sponsors. That's the term in infrastructure for the equity investors. And, those could be, for example, infrastructure equity funds, and they need financing for their infrastructure projects. So, we call them, they call us, we know them really well. We stay in touch with all the big infrastructure sponsors around the world on a regular basis. And that's how we source our loans. And that team that I mentioned, the credit transactions teams, those are the folks within SIMCO that do the sourcing of the loans, as well as the execution and the monitoring. And that's different than if we were managing a corporate bond portfolio. There, not to take anything away from corporate bonds, it's its own market. But sourcing the loans isn't really an issue. You can call up a good investment bank. They'll have plenty of deals that they're bringing to the market off the capital markets desk, or they will have secondary inventory on their books. And so you can pretty much execute over the phone, or what's called over the wire, to borrow an old term, on corporate bonds. But with private loans, you actually, as the manager, you have to go out and source those and then structure them.
Great. And there are a few questions, so I just bundled together again, just around how you manage out situations that go wrong.
Mm-hmm.
So, yeah, very briefly, because given time, if you get a loan that does default, is there always security there that you can get hold of and sell, or how does it all work?
Yeah, it's a really good question. Well, the first thing to note is that we haven't had too many workouts. You can see in that loss rate number that I provided earlier that our loss rate's been really low.
Mm-hmm.
However, this is a natural part of investing. I mean, as we all know, sometimes investments go bad. And what you as the manager need to do is to risk manage that process as best as you can. So the first step is to avoid a loan that's going to be a problem. And you do that through really careful credit analysis. However, unexpected things happen. And the first thing that you would do is can you sell the loan before, if it starts to underperform, in some cases, you're able to sell it. Now, that's certainly true of a bond, and we have some liquidity in the portfolio, some liquid positions. So if we need to get rid of a bond, it's relatively straightforward. With a loan, it's a little bit more complex because depending on the liquidity of that loan, you can either sell it more easily or not as easy. And for example, if it's a loan and it's widely syndicated, then there'll be lots of folks, lots of other investment managers or investors who came in and participated. And if you call an investment bank, they can most certainly or most probably find a buyer of that loan. It becomes a little bit more problematic when the loan is like a bilateral loan or a narrowly syndicated loan where there's naturally a smaller investment base or investor base. But nonetheless, we have sold illiquid loans that were underperforming, so it can certainly be done. If we do take a loan into workout, and a lot of the research on infrastructure does show, and I'll try and keep this brief, does show that the ultimate rate of recovery, this is looking at, I think it's work by Moody's, is oftentimes best if you go through a workout process. And so what happens there? There are different things that can happen, but yes, to answer your question, infrastructure debt is almost always secured, so you do have security. And oftentimes what you'll do is you'll work with professionals and they will come in and, take over the project that's gone into default and try and sell the asset and enforce on the security. Lots of times, if you go through a workout, what you'll end up with is equity in the company. And that's called a debt for equity swap. So there are different things that can happen in a workout, but we have a lot of experience in doing that. The team members at Sequoia have experience in doing that prior to coming to Sequoia, and then we've had some experience doing it ourselves.
Great, thank you very much. We covered an awful lot of ground. I think we better call it a day there. Just one question while we're here. We get quite often.
Yep.
So, do you and the team have a stake in the company?
The directors of the investment advisor do have shares in SEQI, and the company, the investment advisor, also owns shares in SEQI. So there's lots of ownership of SEQI.
Great, thank you very much indeed, Randall. I think we've hopefully demystified some of it.
Great.
We'll get you back again though another time and follow up if we may. But thank you very much for the time today.
It was a real pleasure. Thank you very much.
Good. So we will be back next week talking to John Foster from Impacts Environmental Markets. And then, as I said, we've got a long lineup of things for you. But the week after next, we'll be having our next quarterly panel show. So we've talked about this before. We've got 4 managers on there. We'll be talking about what the impact of the new government in the UK is going to be on their business and the funds that the companies that they invest in. So that should be quite interesting. Thank you very much for tuning in today. And I know we went on a bit long, but thank you for your patience. And we will see you next week. Have a good weekend.